Hi everyone, hope you're all doing well, and today I'm going to talk about a stock that I had to sell last week. So I sold a stock last week. I sold 50% of it, so I sold 50% to move into another company, and the other 50% I am keeping. Now it is one of my biggest positions, and I think it will take a few people by surprise which position that was. But yeah, I felt like it had done very well, and I wanted to invest it into a new opportunity. So I thought, let's just take half of it off the table now and keep the other half in case we still carry on going up. But I felt like we were kind of near our peak, or there wasn't as much upside left, and I felt like there was a better opportunity out there. So like I said, I did take 100% return on that. So it's added into the 100% return club, and it has been a very good year in the stock market, really, for me. The amount of really good returns that we've took has been absolutely brilliant, and this has just added into that list of another 100% return. And it's always good to see that, you know, it was one of those stocks as well that at the time it wasn't those, you know, really easy stocks. You know, I bought this stock that I bought. It was a stock that I bought, and I went down 10%, 20%, 30%, and you know, when you're down on that stock, you know, 30%, you do start going, have I made the right decision here? Is this still a very good investment? And it was one of those investments that I had the belief to just carry on holding, to carry on averaging in on. And yeah, it is one of those that has turned out to be very successful. And it reminds me of what we kind of, a few stocks that are happening right now, you know, them stocks that you're down 10, 20, 30% on. Just a bit of a reminder that this is a stock that was very similar, and it does turn around. And I think that is it's always good to see one of the stocks that you invested in play out, and you do make money from it. You know, it's one of those times to actually be really excited is when you have taken that profit off the table and you've got that cash to go spend. And the reason why I sold 50% on this position for 100% return is to use that cash for a new opportunity. So what I'm going to show you today is the stock that I sold is a stock that I felt like had limited upside. It was a stock that I thought will do 100 to 150% return in the next 5 years. Obviously, with me already at 100% return in just under 2 years, I thought, well, that's done even better than what I thought in that time frame. And the upside is now a little bit more limited. And because I saw an opportunity out there, which I was like, okay, which is better to have my money in? Do I keep it in this stock? Or if I take that money out of that stock, is there an opportunity that will outperform this one? And that's what I saw, especially this week. So we'll go through it all, and hope you enjoy the transparency, and we'll get started. Now, if you do want to know when I'm buying or selling companies, make sure you join the Patreon. Links in the description. There's also 2 exclusive videos a week on there, as well as a Discord with 600 investors to talk to. As well as that, if you do want to start investing, there's a link to a free trade account in the description as well. Join through there and you also get a free share. But the stock I sold 50% of last week was Greggs. So I did sell 50% of this position. It's a stock that I've had just short of 2 years now. And like I said earlier, you know, this was one of those stocks that you start buying and then you actually go down on the position. I mean, look at that, 30% down on the position. And it is a really big test of your belief in the company, but it's one that I believed in. And since then, the stock, I just carried on averaging in on that drop there for that 6 months period. And then the returns have come in, and the stock has done absolutely amazing. And it's kind of flatlined a little bit now. I just believe that's because people like me are looking at this one now going, it's not attracting any buyers, because buyers are looking at that going, there's not much upside left. And I think it's just consolidating here because of the valuation it's at. And then as well as that, I thought, you know, this is one that I don't think there's as much upside left on this one now, so I'm going to take that profit and move it somewhere else. Now, it is a 3 billion market cap. It's trading at price to earnings of 36, which we're going to talk about in a little bit more detail in a second. It does pay a little bit of a dividend yield. I was considering, like, obviously, do I hold this position? Do I carry on picking up that dividend? And that's why I thought, you know, I still think it's an amazing company, and I still think I will get, you know, a bit of a decent dividend yield off it, because I'll actually get higher than this, because I'm down here. My yield will be a lot higher. But with everything there, I still think there's a better opportunity out there, which we'll cover in a second. Now, with Greggs, I did look at this and think, okay, let's replan this. Can this go all the way up now to 6,000? Can it double up from here? Is it worth me kind of holding this company? Now, to get to 6,000, in my opinion, what Greggs will have to do is they will have to probably double the profit they're doing. Now, to really double the profit they're doing, you would have to go from either increase your profit margins or increase your revenue. So you can see here, Greggs went from 894 million, and if we just go to what they're going to do now, which is 1.12 billion. So you can see here the revenue has increased a fair amount, but it hasn't doubled. So there is still a very good revenue increase, but for them to carry on matching up that valuation and to double up again, that revenue would probably have to double. And you can see historically they don't really double revenue. It does go up in the right direction, and that will obviously go down to the profit, but the double up really for the share price won't come from the revenue. And if you do go on the past performance here, you'll see that they used to do 55 million profit, and that was around about a 6.1% profit margin. So if we go on to what they're going to do now, which is 112 million, and that's off 1.2 billion, you can see here the profit margins are a lot higher now. So you can see the profit margins are currently around about 10%ish. So how Greggs has previously done very well is that it has increased that revenue at a really good rate, but as well as increasing the revenue at a really good rate, it's increased the profit margin a massive amount. So looking at this in the next 5 years, can I see Greggs still increasing that revenue at that sort of rate? Can it increase its profit margins? And you'll have to be increasing your profit margins to 15+%. That's the little tricky part that I come on, to double up from here. I don't know if Greggs has the potential to grow at that rate. I don't know if it can, how many more Greggs stores can it open up? It would have to probably look at international expansion to do that. And then that's a question of, will that be successful? And then also to improve that profit margin, it's very hard to get something like a Greggs to kind of then go up to like now a 15% profit margin. So from my point of view, I just looked at that risk and going, can they carry on doing this? Potentially, but at the same time, there's a bit of risk out there. There's a bit of the unknown. So I think two of the massive challenges Greggs will have will to be increase that profit margin and that revenue, which is why I kind of thought, okay, maybe it's time to take that risk off the table. Because realistically, can I see the share price doubling again? Maybe, but not as confident as what I was from buying at these sort of prices to 3,000. So that's probably why. And the other thing that I had to take into consideration is that there's going to be probably a massive management change in the next 2 years. Currently, Roger Whiteside has been with this company for the last kind of 8 years, as you can see here. And he's been basically one of the main reasons why this company has been able to do so successful in the last kind of 5-10 years is because of him and his management team. So my kind of worry is that Roger Whiteside is now 63 years old. His intention was to retire a while ago, but he has now stayed on through the pandemic. And now that we are kind of moving away from that, or we hope so, we'll see what happens. But now that we're kind of moving away from that, my worry is that he will probably look to step away from the company. And then if we have a new management in here, then can new management carry on doing what he's done, and can they deliver on the plans to expand, to get that growth up, to get that margins up? So the big thing here is there's a lot of unknown where they go to expand, and as well as that, probably one of the best CEOs that I have in my portfolio is him, and I have to be aware that he's probably going to step away within the next kind of 24 months, I would expect. So yeah, that's also something that I have to consider as well. Now, as well as that, the valuation, like we talked about earlier, is very stretched on Greggs. So you can see here they're at 36 times earnings that we talked about earlier. If we just jump across here, you'll be able to see, if we just go on the forward multiples, you see the price to sales ratio normally trades, 1, all ones here. We did get a 2 there, but 1. And you see what we're at the moment, we're at a 2.5. So historically, we're trading quite high on a price to sales point of view. If we go on the normalized earnings, you can see here 15, a lot of teens, a lot of teens here, 23, 26, 23, 25, back down to the teens. Obviously this is a massive increase because of the CV situation. We're currently down at 20, we're at 27 now on a forward basis. So yeah, you look here, this is a stock that historically trades in the normalized earnings of the teens, and we're up at 27. So obviously, bit of a premium on the earnings front, bit of a premium on the sales front, and pretty much every kind of metric here you go through, it is at the higher end of a lot of its metrics right now, which is also the standout thing. So yeah, when I look at it, there's a lot of uncertainty how they carry on growing. There's a valuation problem. There's probably going to be management change. So all them sort of combinations came in, and I thought, okay, I'm a bit short on cash, and there's another opportunity out there that I really want to buy quite heavy now. So I thought, we'll take 50% profit off the table for this one. Then what happened is I put it into this company, which is called Boohoo. So I've made a full video on this one this week. It was about 25 minutes long. So do go check that one out, because I'm not going to talk about the company at all today. I'm just going to talk about why I bought Boohoo. So I did buy more Boohoo. The reason why is because I look at the likes of Boohoo, which is going to be the better performing stock, Greggs or Boohoo. In my opinion, it's Boohoo. For me, Boohoo is already a stock that should be £3. So right now Boohoo should be a £3 stock. So you look here, well, that's already 100% upside here. And then you factor in, well, if Boohoo go back to, historically growing 20+% revenue, that goes down to the bottom line. Then you start factoring, well, Boohoo could potentially be above, a £5 to an £8 stock here. When it starts getting in that range, and then you look at what price it is, that is a lot of upside. That is plenty more upside than what is in this investment. So straight away I thought, well, is my money best to sit in here where I could probably get a 20, 30, 40, 50% return, or is it to go in this one here, which I think is easily 100% straight off, and then has the potential to do 200, 300, 400% return? And I thought it was this one. So especially with this going on a massive dip, I thought, okay, we need to start putting more money into this one here, start buying up this dip as much as I can right now. And that's what I was doing with this one. And then with the likes of Boohoo, for example, if we just go back to the same sort of point and looking at some valuation metrics here, you can see that Boohoo historically, look at the price sales ratio from their point of view. 4s here, 5s, a lot of 2s, 3, 2, 2, 2, 2, and look at what we've done recently, 1, 1, 0.61. So you can see here, on a price sales ratio point of view of Boohoo, look how much that's actually just sold off now on a metric point of view. If we go on normalized earnings here, look at this, 60s, 80s, 50s, 30s, 40s, 30s, and then all the way down here, 13. So you can see here, like on a price sales ratio point of view, on a normalized earnings point of view, and it's the same one here. You can go on, EBITDA as well if you wanted to. All of these metrics are just absolutely cheap right now. The only one that isn't cheap is free cash flow, and that's because of some of the investments that they made this year, and that will go back to being normal. But everything else here, all the metrics are the opposite to, Greg's, for example. We looked at Greg's. All the metrics are at all-time highs. You look at a Boohoo, all the metrics are all-time lows. And what do I like to do? Sell high, buy low, and this is exactly it. You can see the metrics of Greg's are high. Look at the metrics of Boohoo. It's all down low, and that's what I'm doing. I'm trying to look for the next opportunity, and I believe that is there with Boohoo. So move that cash, especially when I've been burning through the cash pile a lot recently. Move that cash into a better location, and that's what I did. So I hope you enjoyed the video, and very happy to make some really good money on Greg's, and also now positioning myself for the next stock that I believe will do very well in the next few years, and moving that money into what I believe is a better opportunity. So hope that video was useful anyway, guys. If it was, hit the like button. If you're new and you found the video helpful, subscribe, and I'll see you on the next video.